Welcome everyone to FX Street. It is Tuesday, 8:30 a.m. Eastern. February 8th, 2011. Welcome back, one and all. Great that you could join us. Today, as always, we have a very fun topic to talk about. One of my first interests in financial markets, technical analysis, specifically chart patterns. And what we're going to do is we're going to try to identify the most common chart patterns that we see emerge over time. Chart patterns at the end of the day reflect the buying to selling pressure. You know, if we didn't have the chart to look at, once upon a time, speculators in financial markets did not have charts. They simply recorded prices down on little pieces of paper, or they just remembered them. And what the chart does is it allows us to visually identify, okay, where's a trend? Are prices, generally speaking, going up or going down? And we'll think about it, you know, we don't need a chart to note the own price of our own home, you know, because we know those prices very, very well. You know, we know that our home was worth $100,000, then it was worth $200,000, and the housing market crashed and it went down to $150,000, and now maybe it's worth $175,000. So if you could mentally sort of try to capture, you know, visualize in our own minds how much the chart of what our house price would look like, I think it would be pretty easy. But with foreign exchange, you know, things change very quickly, and like the stock market, things change very quickly, and it's, you know, a very good asset to have these charts at our disposal. So what we're going to try to do is identify, number one, the current condition of the market, meaning range-bound or trending. Range-bound market is a market that tends to go from the low to high, but does not make new highs or new lows. A trending market condition is where the market tends to make new highs or new lows. Now, as I always like to say, within every trend there's a range, and within every range there's a trend. Let's start with the euro-dollar. We're going to get through the dollar majors, euro-dollar, pound-dollar, etc. If there's any other specific currency pairs you'd like to see, please don't hesitate to chat them in. Now, first thing I like to do is draw our support and resistance. Support and resistance is drawn from the lowest low to the second lowest low. If the market then breaks that low, we have to readjust the line. So we would draw our support level as follows. From the lowest low on the euro-dollar, we're looking at a level of June 8th. If I can get this line just about perfect. Whoops. There we go. June 8th of last year, we can see the market eventually broke below. And that's okay. It just means that the trend has changed. For the time being, from June 8th of last year all the way through, looks like August 20th, the buyers very much overwhelmed the sellers, and this caused a very steep angle to the upside. Eventually, the sellers gained a little bit more equilibrium, and the market pulled back towards the center and broke below the support line. So what we must do is readjust this line. However, if you leave this line up here, sometimes it does serve a purpose, because what we see is that our former support level, once we break below, sometimes becomes new resistance. Not really the case here, but oftentimes it does. I would then readjust it to the next most significant low, and as we see over here, the former support level actually did, in fact, represent new resistance, with the exception of this minor breakout to 138.61. We need to see the euro-dollar break above 137.50. If we cannot, this could be our new resistance level. But let's readjust the line to incorporate the most recent significant lows, and this takes us down to those lows of January 10th of this year. Now, as we draw support and resistance, I always like to draw support first in an uptrending market. The reason being is because in an uptrending market, the trend is your friend. I want to only trade in the same direction as the trend. In an uptrend, I only want to go long. In a downtrend, I only want to sell shorts. Well, given this is an uptrend, because we're making higher lows, what I would want to do is go long. Where? As close as possible to supports. Let's change this color. And this visually, just to give you an idea, obviously not exact, but just to give you an idea where I'd want to go long based on supports, just a little bit above our current support level. Protective stops should be placed below support. Theoretically, or logically I should say, at a place where we do not expect the market to trade to. So, as we draw support, support should connect the most recent significant lows. resistance, recent significant highs. Support should always be drawn first in an uptrending market. Resistance should be drawn first in a downtrending market. Now, in addition, support and resistance oftentimes form a parallel pattern. They emerge in a parallel format, so to speak. So we draw a line that's parallel to support, drag it on up, connect it to our recent significant highs, and that could become our new resistance, as follows. Now, in addition, we have another possible support level, or not support, but resistance, and that is in the middle of what's known as a possible head and shoulders pattern. Head and shoulder patterns sometimes emerge as a standard head and shoulders, meaning we have, and I'll show you a little bit later on in the Aussie dollar chart, we have the two shoulders that are equal height and the head at the center. But in this case, we have an inclining head and shoulders pattern. Nevertheless, it does represent future resistance. With any trending market, in addition, we should also consider Fibonacci levels. Fibonacci levels are a very, very important part of really foreign exchange trading. Fibonacci levels we draw from the left side of the chart. So in an uptrending market, we would start at the bottom. In a downtrending market, we would start at the top. Draw Fibonacci lines from the most recent significant lows. That is, again, June 8th. Let's start from the beginning. June of 2010 up to the highs of August 2010. We pulled back. The lines that emerge below us are Fibonacci retracement levels. We don't know which line is going to represent new resistance or new support, but we know the probability of support will emerge near one of these Fibonacci lines. In this case, Fibonacci did emerge at the 50% retracement level. That represents 50% of this entire move up that we measured. We pulled back down to 50% Fibonacci retracement level, and then we moved forward. We broke to new highs. As we broke to new highs, this confirmed the trend. Where was our likely price target? At a Fibonacci projection level. Fibonacci projection levels use the same percentages as the retracement levels, but instead of subtracting the percentage from the top, we add it to the top. So a 23.6% Fibonacci retracement level is 23.6% of this trend minus the top. 23.6% Fibonacci projection level is this resistance plus the top. Now, we ended up forming a top almost exactly at the 61.8% Fibonacci projection level and then pulling back. An important point is that former resistance oftentimes becomes new support. Sometimes it does not. So please be aware. Now, if we see these lines intersect, if you see horizontal lines, our former resistance becomes new support, and Fibonacci, if these lines intersect at a particular spot on the chart, it means a lot, especially if the horizontal lines, the diagonal lines and Fibonacci lines tend to meet the same place. Sometimes this happens, sometimes this does not. If it does, it certainly behooves us to pay attention though. Now, watch this. As we measured our former Fibonacci distance from June of 2010 to August of 2010, I'm going to maintain the same difference, but I'm going to drag our former support level to our new support. Sometimes our former resistance will become our new resistance. So we drag it on up as follows. Did not fit exactly. Sometimes it does though. Again, former support becomes new support. Former resistance becomes new resistance. Let's readjust the lines. The market moves on up. We pull back to the 78.6% Fibonacci retracement level. Now, the 78.6% is a big level because that is the last semblance of possible support on the way down. If we break below the 50%, we know we can go to 61.8. If we break below 61.8, we know we can still go lower. 78.6%, if we break below that, that's it. That not only takes away the possibility that we'll hold at a Fibonacci level, it takes away the possibility that we're still in a trending market. Remember, a trending market looks like we're walking up a flight of stairs. Higher lows, higher highs. If we break below the 78.6% Fibonacci retracement level, that takes away the possibility that we will establish a higher low and gives us a really good chance of a double bottom pattern or maybe even a lower low. 78.6 is important. Oftentimes, we will find support or resistance will emerge right near the 78 or right near a Fibonacci level with a double bottom or double top. Look for double bottom patterns and double top patterns on the Fibonacci levels. Those are really important. Now, in addition to that, we can see that the market then subsequently rallied up. We did not make a new high so far. We do not know the market is still, the current trend to the upside is still intact. We know those highs of 142.81 on November 4th are still very much intact. If we break those highs, that will be a confirmation of a new trend to the upside, and then we will look for Fibonacci projection level. Coincidentally, our 23.6% Fibonacci projection level and our uptrending resistance intersect the same spot. That's important. That's right around 147, by the way. So in other words, if euro-dollar breaks above the highs of 142, 143, 147, I think we have a very good chance to accomplish that. If we break below the 78.6% Fibonacci retracement level, then I don't think so. Then we have a very good chance for either a reversal or at least a range-bound market. Now, question always comes up. I don't have the tech dashboard in front of me, actually, at this moment. Question always comes up, though, that the question is, how far back, what time frame should we use charts? You know, we're looking at a daily chart right now, and I went back to 2009, and you know, we could certainly zoom in on this chart and focus in on the current data that we've seen over the past couple of weeks since the beginning of the year, maybe. Or we can zoom out to 1999 and get a much, much bigger picture. Generally speaking, I like to go back around 1 year on a daily chart. I always like to start with the long-term charts, specifically the daily charts first, to get a nice reference of what we're looking at. We can go back further. Nothing wrong with that. But I think it's important to go back at least 6 months to a year on a daily chart because we want to get a good piece of statistical information as far as what we're looking at. You know, I always like to equate charts to a presidential election. If we were to ask everyone in the U.S. during the next presidential election, are you going to vote Democrat or Republican? Well, you know, 49% may say one side, 51% may say another. But that result will give you a very good indication. If you ask everybody in the U.S., who are you going to vote for president during the next elections? If everyone answers that question, you're going to get a very good indication of who's likely to win. That's a very good piece of statistical information. Well, then from that point moving forward, I can go to asking only everybody living in New York State. And that might give me a little bit of a different representation because everybody in New York State does not necessarily represent everyone in the U.S. And then within New York State, I can ask everyone in Manhattan. And within everybody in Manhattan, I can ask everybody living only in downtown Manhattan. Well, as obviously you can see where I'm going with this, that the smaller amount of data that we collect, whether it's a presidential election or we're looking at a chart, the less representative that it probably is in terms of the overall trend or the overall population. Now, it is important to look at short-term charts, the same way it's important to poll, you know, downtown Manhattan versus, you know, uptown Manhattan to determine, okay, who's going to win the election for the assemblyman or the mayor or whatever it may be or the police commissioner. But at the end of the day, I think it's always important to start with the long-term charts to get a sense of the long-term trend. After all, the euro dollar, and we'll look at the pound dollar and Aussie dollar, they have very strong, very specific trends to the upside. Not so much euro dollar, but the pound dollar and Aussie dollar do. And that, yeah, that's a long-term trend to the upside. But what if I were to look at a 5-minute chart of the euro dollar, and I'm going to really zoom in. I'm going to say, well, right now, euro dollar 136.33 in a 5-minute chart going back, you know, just an hour or so. This looks kind of negative. Yeah, euro dollar I think is going down. Let's sell short the euro dollar. And it, you know, hey, well, it looks like we're breaking new lows as we speak. But again, going back to the daily charts, hey, long-term trend to the upside. That puts that downtrend that we're looking at the moment, that 5-minute chart downtrend, in a completely new perspective. You know, all of a sudden now, we don't say to ourselves, no, I don't want to sell short the euro dollar. I hope it pulls back because I want it to pull back to my projected support level, which by the way is around 130 on a very long-term basis, or our former resistance, this former highs, that 50% Fibonacci projection level, that could be new support near 134. That could be a good area to go long. And we can continue to zoom in to establish the shorter-term time frames, on the short-term time frames, the shorter-term trend lines and that actual trend. But always keep in mind the long-term trend. Again, if there's any particular currency pair that you'd like to see, please don't hesitate to let us know. Pound dollar daily charts. Drawing support line connecting from those very, very significant lows May of last year up into the next most significant lows, December 29th of last year. We can see a long-term trend to the upside. That's nice. Again, this chart's going back to December of 2009, so we have about a little bit more than a year of data. Well, let's try to draw a parallel resistance. You'll see if the resistance lines fall in somewhat of a parallel fashion. And in fact, it does. We know because we can connect two significant highs. All these lines, again, represent is the ratio of buyers versus sellers. Right now, the ratio of buyers versus sellers, I don't know exactly. If I had to guess, I'd say 2.5 buyers to 1 seller, maybe 3 buyers to 1 seller. Every time the market goes down, there's more buying pressure and selling pressure. That helps us establish higher lows and higher highs all the while. The fact that we see a double top over here, that we failed to break above these highs, the market constantly has to prove to us that the trend is still intact. We hit highs of 162.96 on November 4th of last year, which, by the way, bit large round figures are always important. 163.00, big number. We then again touched 162.76 on February 3rd, failed to break above. That causes a little bit of suspicion. Now, officially, we won't know the trend is over until we break below uptrending support, which, by the way, currently is at 155, but this does draw a little bit of suspicion. We also know that the trend would be broken if we break a Fibonacci level. Let's draw Fibonacci levels. Again, starting from the beginning, the bottom of the charts of May 20th of last year, drawing them up to the highs of August of last year, we pulled back 38.2% Fibonacci retracement level. We rallied up, but we failed to hit the 23.6% Fibonacci projection level, which, by the way, did at one point intersect with our uptrending resistance at 164. Nevertheless, we need to see the market break to new highs above 163 in order to confirm the uptrend. If we do break above 163, then the next projected resistance is the first Fibonacci projection level. That's at 164. If we pull back, it could represent a good place to go long. By the way, again, remember, double bottoms and double tops almost always emerge near a Fibonacci level. Or I should say, when the market turns near a Fibonacci level, it's almost always a double bottom or double top, at least, from what I've seen. This current trend has not been confirmed to the upside because we've not broken the new highs. Does that mean I don't want to buy it? No, I still want to buy it. I would feel a lot more comfortable buying it with a confirmation. But then again, once we get that confirmation, it would mean that pound dollar would have broken already to 163 and above, and therefore we would have missed a trade. So the confirmation that tells us, yes, this trend is intact, and the actual entry to get involved, two different things. That's the rub, really. That's the trick as far as trading. If we wait until we get the final confirmation, then that means we would have missed the trade. If we take the trade, it means we're taking the trade without the final confirmation. That is a risk in trading. The fact that I want to go long where? Near uptrending support, near 155. I will not know this uptrend is intact until we hold at 155, bounce back to the upside, and then eventually break to new highs. Let me take a look at the chart in silver next as well. Looks a lot like naked trading. Yeah, absolutely. But, it's a great comment, actually, because the charts on its own, it does ask us, it does require us to place quite a bit of faith in the charts and say, how do I know that this trend line is really real? It's just a trend line. Maybe it's a coincidence After all, it's just 2 points that connected the trend line. The way we use trend lines is we connect the first low to the second low. Well, we don't even know this trend line, I drew this correctly, until the market tests and fails to break below the third low. And that would be, near the trend line. How do I know these Fibonacci levels work? Yeah, maybe they work. Maybe it's a little bit of self-fulfilling prophecy. But, we do have more information, and I think this is what the other side of trading, the other side of analysis that really fills in the blanks as far as speculating in the financial markets. We have technical analysis. I have a friend of mine that I always like to use this quote. A friend of mine, really bright trader, he always used to say this. He would say that fundamental analysis establishes the bottom and tops of markets. The bottom of the market and top of the market are created from fundamental analysis, news. Technical analysis explains everything else in between. And if you think about it, I think that silly little joke makes so much sense. It's not naked trading if we have the fundamental analysis to guide us forward. Now, we know the number one if we're applying fundamental analysis to the stock markets, we would say, I want to buy a stock that has good earnings, good revenues, Apple computer, the new iPad, something fundamentally that has helped that company grow, get more customers, make more money. Foreign exchange, it's even easier. We know currencies move under the anticipation of their implied interest rates, where interest rates are now and where the market thinks interest rates will be based on the economic data. Who sets interest rates? The central banks, European Central Bank, Bank of England, etc. So foreign exchange currencies move under the anticipation of higher or lower interest rates, influenced by the news. Well, then we took a look at the fundamental analysis of the UK, and previous speaker Ed had so correctly had stated that, it's a growing anticipation the Bank of England will raise rates. Growth, the last numbers, I think Ed is correct, 3.7% inflation rate. That is pretty good. That shows a lot of growth in the UK. Compare that to growth or inflation in the US, just barely in the positive realm. We have two members of the Bank of England Monetary Policy Committee. I believe his name is Martin Wheel and Andrew Senton. They have both already voted to raise interest rates. The rest have not. But there is a growing anticipation the Bank of England will raise rates. And there's economic data to support the Bank of England to raise rates. In the U.S., take a look at the housing market. Inflation has ticked up a hair. The housing market has ticked up a little bit. But I think we're just ticking up right off of the bottoms. The economic data in the UK looks significantly better than in the US, and I think that most of us really anticipate that the Bank of England will raise rates sooner than the US. And we already have a little bit of higher interest rates in the UK versus the US. So you have that natural carry trade, that difference in interest rates. Therefore, I think the pound dollar to the upside makes a lot of sense. Point being, we put the technical analysis together with the fundamental analysis, starts to make a lot more sense. Let's try to find a silver chart. What is the symbol for silver? I almost never use it. Does anybody know offhand the symbol for silver? YM is a Dow. CL is crude oil. That's the Nikkei. Is it silver's S? I hardly ever watch silver. XAG. It's not. Is silver around $1,400 an ounce? I don't think I have XAG. I didn't see it. ZDX. If anybody knows, I don't see XAG. I know that is a symbol, but that's not what the MetaTrader is using. I think the CFD. Anybody know the price of silver? Is it around $1,400? Can't be $1,400. That doesn't make sense. $29.65. Let's try to find. Let's see here. MetaTrader silver symbol. Yeah, I know gold is up near 1,400. Trying to figure out what the MT4 MetaTraders use for the silver charts. I'm not sure I have it. XAU is gold. You know what? I apologize. I don't think I have it. I don't have it on my charts. XAU. You are right. It's XAG. I apologize about that. I have most of them. I don't have all of them. Euro dollar. What do I see? I see a long-term trend to the upside at 136. Uptrending support is down near 130. I do think that these former highs of 134 could become new supports. I would look out for that. 134, if not 130. Long-term trend looks healthy to the upside. We could zoom in on the euro dollar. I want to get to some other currency pairs as well, but we could zoom in to the euro dollar. We could draw Fibonacci levels again. And we do have other Fibonacci retracement levels, specifically a 38.2% near 135, matched up with actually yesterday's lows. Healthy trend to the upside. It's not the strongest trend, but there is a trend. Now, so far we've talked about trending currency pairs. Most of the currency pairs are not trending these days. Most of them are range bound. We see a downtrending market, or a lower. We don't really see, well, I tell you what, we can draw a line parallel to resistance and drag it on up, drag it on down. That could represent new supports. But before we get to that point, we can also draw a support level that's connecting the higher lows. This is not a range-bound pattern. This is not a trending market condition. This is a range-bound market. Range-bound markets, which oftentimes look like triangle consolidation patterns, emerge when we have lower highs and higher lows. Most of the time, the foreign exchange market, I forget the exact statistic, I'm guessing between 60 to 80% of the time, the foreign exchange market is actually range-bound. Now remember, within every range, there's a trend. Within every trend, there's a range. This is a daily chart. If we're to go to a 1 hour chart, we'd say, hey, this looks like a nice trend to the upside, and you would be correct. But remember, time zone or time frame is everything. And on a daily chart going back about a year, which is really like the basis from what I like to start with, we have a range-bound market. Well, going back less than a year, going back a few months, the market is very range-bound. In a range-bound market, well, in the trending market, we say the trend is your friend. In a range-bound market, there is no trend. So it doesn't really matter if I buy or sell. I can do both, but I want to buy near support or sell near resistance. A great indicator, by the way, to use in a range-bound market is something called the Bollinger Bands. Bollinger Bands, we have a simple moving average, 20 simple moving average, and that same 20 simple moving average extended 2 standard deviations below and above, and that gives us a very nice area to approximate where I want to buy or sell. Look for the Bollinger Bands to intersect with the trend lines. Extra confirmation. It actually does happen right here on 93.30. I want to go long with the dollar Swissy at 93.30. I want to sell short the dollar Swissy at 9600. Now, fundamentally, and then again, we can always throw in the fundamental analysis to get a better idea to, make a more intelligent trade. Fundamentally, what are the chances that the U.S. is going to raise interest rates? What are the chances that we will see interest rate hike in Switzerland? Not very high either. However, we know the Swiss franc tends to benefit from high gold prices. Anybody watching gold over the past couple of years knows gold, $1,400 an ounce, historic highs, an unbelievable trend to the upside. So as gold has continued to rally, the Swiss has continued to rally. Put a strong gold market against, and that obviously helps the Swiss franc move up against the very, very low anticipation that the Federal Reserve is going to raise interest rates, creates a nice, healthy trend to the downside on a very long-term basis with the dollar Swissy. So, point being, even though we're in a range-bound market, even though we do not anticipate either central bank to raise rates, when we start to take into consideration the effect of gold to the Swiss franc and the fact that we buy gold as a hedge towards inflation, a hedge towards a falling dollar, if the dollar continues to fall and gold continues to go up, and the anticipation of inflation, meaning that a weaker dollar can buy less euros and a weaker dollar can buy less pounds, well, that in turn is going to lead us to believe the dollar Swissy will break new lows. That's why fundamentally going long the dollar Swissy actually doesn't make that much sense. However, the charts do tell us 93, 93.30 does represent support, resistance near 9,600. Notice if we draw our Fibonacci lines, the most recent lows to the most recent highs, we broke through all the Fibonacci lines. We know we are not in a trend to the upside, because if we were in a trend to the upside, we would have to hold at the 78.6% level. We will not confirm that we're in a trend to the upside until, in fact, we do hold at least one Fibonacci level. Are we in a trend to the downside? Draw our Fibonacci's from the most recent swing highs, recent swing lows. We did, in fact, hold at the 61.8% level when we rise of 95, 97, actually yesterday on a daily chart. 78.6% level is up near 9690, 9700. If we break above that, that would mean we would have to readjust our lines, and it would form a really large triangle consolidation pattern and confirm the range-bound markets. Dollar Swiss is a pretty easy currency pair to analyze because of this triangle, but also because of the overall tendency of the downside. So at the moment we're in a range, but the Fibonacci levels and the longer-term charts actually tell us we're in a very long-term trend to the downside. Better to sell shorts. Maybe I can take profits near 93.30, but much, much better to sell short. At least that's what the charts are telling us to do so far. Please feel free to chat in any currency pairs that you'd like to see, by the way. Dollar yen, this is an official range-bound market. Higher lows all the while, lower highs all the while. Triangle consolidation pattern. Fundamentally makes a lot of sense. Both the Bank of Japan and the Federal Reserve have kept interest rates very, very low. Neither the Bank of Japan nor the Federal Reserve is expected to raise rates anytime soon. Now, the Federal Reserve is not expected to raise rates, well, because the economic data has not improved enough. Bank of Japan is a little bit of a different story. It's an export-driven economy, and the Japanese economy benefits from low interest rates, so the Bank of Japan won't raise rates very, very high, even in the best of times. But for the time being, the combination of low interest rates and the extreme low expectation that either central bank will raise rates, the dollar and the yen fall very, very close to each other fundamentally. Technically, 82.17, we're right in the middle. Now notice, by the way, long candlestick wick. Long candlestick wick at the recent swing low. Market oftentimes turns, and at those turns emerges with a long candlestick wick. It tells us the market went down, 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 but at the end the buyers told us, I'm not going to let you close near the bottom, we're going to push you back up. Same holds true for resistance. The market goes up, 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 and just at the point we think we cannot stop going up, long candlestick wick tells us the sellers pushed us back down before this candlestick was able to close the day. Same thing happened again. So when the market's going up, 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 or down, 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 and you're long, then let's say you're making a lot of money because the market goes up every day, look for those long candlestick wicks to emerge. When they emerge, oftentimes it's an early sign of a turn to come. Nevertheless, dollar yen is in a long-term triangle consolidation pattern. Again, range-bound markets, Bollinger Bands. Buy low, sell high, take profits in the simple moving average, right in the center. In a trending market condition, we would only want to trade in the same direction as the long-term trend. And therefore, I would either want to buy low or sell high, but not both. For range-bound markets, we can feel very comfortable to do both. By the way, a breakdown occurs when the market breaks between new lows. A false breakdown is actually an excellent sign of a confirmation of our supports. The fact that we traded at new lows, yet the market was not able to follow through with those new lows, gives us extra confirmation that support did in fact hold. We have a huge advantage when trading foreign exchange as opposed to trading a single market like the stocks, like buying a stock or buying gold or silver or a particular commodity, because we have the basis of comparison between two currencies. And when we look at a currency pair, I think the best way to do so is to construct the currency pair first fundamentally as far as which two currencies should I try to put together. Think of the mechanics of a currency pair. A currency pair like the dollar-yen moves or doesn't move because the two currencies within that pair are either moving together or moving apart. The dollar and the yen right now are kind of moving together. When the economy in another nation does well, we sell our low-yielding currencies like the dollar and the yen and the Swissy, and we buy our higher-yielding currencies like our Aussie and our Kiwis, or maybe a currency that we anticipate that central bank will raise rates, like the UK, the Bank of England, British pound. When the two currencies in a currency pair move in opposite directions, when the dollar goes down and the pound goes up, the pound-dollar currency pair moves. When the dollar goes down and the yen goes down, or when the dollar goes up and the yen goes up, the currency pair does not move. So when we're thinking to construct a currency pair, and we want to look for the strongest trend in the foreign exchange market, we should try to find the weakest and then the strongest and put the two together. By the way, in terms of the Bollinger Bands, I always have default settings, which is 20 periods, moving 20 periods back, 2 standard deviations on a closing basis. You look for the closing candlestick, 20 periods back, 2 standard deviations, 20 and 2. Let's talk about a currency pair, and obviously the dollar-yen is not moving because the dollar and the yen are kind of going together. But let's think about this. What is a currency that has been very, very strong lately? What's a currency that has been very, very weak lately? Well, what central bank do we think is going to raise rates probably the soonest? Let me ask all of you. This is a very good amount. Please chat in which central bank do you think, or you can type in the currency, pound, euro, dollar, Swissy, Aussie, Kiwi, yen, etc., CAD also. Which currency do you think has the best chance to see higher rates in the near-term future? Emma says European Central Bank, euro. I happen to agree. I think European Central Bank is right around the corner from raising rates. The numbers have been very good. Some may say Australia. Now, we've had some negative news out of Australia lately. We know that Australia benefits from a high commodity prices. So if we see gold and silver go back to the recent swing highs, that's good. We know the data in Australia has not been that fantastic lately, but then again, Australia, the Reserve Bank of Australia will raise rates. If we anticipate the worldwide economy to improve, we would anticipate the Reserve Bank of Australia to raise rates. And of course, the Bank of England, I think, is pretty likely to raise rates soon. I happen to agree with all three picks. A close fourth, maybe even the Bank of Canada. Australia's property collapse looming. Wow. Now let's think of a currency that is least likely to raise rates. Now, we could say the dollar, and I would agree with you, maybe the Swiss franc. The Japanese yen is a very obvious choice because, again, the Japanese economy is an export-driven economy. Even during the best of times, we only saw rates in Japan near 0.5%, 0.5%. So we can compare a very strong currency like the pound, Aussie, maybe the euro, to the yen. Pound yen, euro yen, Aussie yen, and that will help us construct the strongest trending currency pair. Now we look to the charts for actual confirmation. Aussie yen, 83.30. We hit highs 83.68 on December 12th. A break above that would confirm new highs. Did we hold at the Fibonacci level? from our double bottom pattern, drawn on up, and we did hold, in fact, at the 50% Fibonacci retracement level. Let me try to get this line a little bit better. There we go. 50% Fibonacci retracement level. Again, we won't get the final confirmation until, in fact, we do break the new highs of 8,800. But there's a moderate trend to the upside. The fact of the matter is we can gauge the strength of the trend very, very easily by drawing a support line and asking ourselves the question, did we break this initial support line? The answer is yes. We had to draw a more conservative support line with a less of an angle. So yeah, and this is an Aussie Yen weekly chart. Let's go to a daily chart just to keep everything fair. Yeah, all the same. Yeah, Aussie Yen, it did break its initial long-term support to the upside. So yeah, the trend is to the upside, but not to a great degree. Compare that to the cable yen. Now let's try to keep everything fair. October 2008 is how far I went back on the Aussie Yen daily charts. Let's go back to October 2008 on the cable yen charts. Does the cable yen look as healthy of a trend to the upside as the Aussie Yen? Absolutely not. Cable yen, if you just look at the charts, doesn't look very good at all. Did we break our trend line? A long time ago. It actually looks like we have more of a trend to the downside than we do the upside. Showing our Fibonacci levels in those recent swing highs, recent swing lows, very significant swing lows, very significant swing highs. 78.6% Fibonacci retracement level. That's the last semblance of support. We've already broken well below that. And it was a long term. I mean, you can't really argue with these trend lines going to the downside. We are, and we have been establishing new lows and new highs for quite a while now. That doesn't work. Let me take that away. Point being, fundamentally, yeah, I think the Bank of England is not that far from raising rates. The market so far, at least as far as technical analysis tells us, does not agree yet. We are not holding Fibonacci lines. We're not holding support lines. How about the Euro Yen? Speaking of the Euro Yen, great question. How about the unemployment in the Eurozone? Where's unemployment in the Eurozone? I think it's still around 10%. Was at 10.1%. I believe it's at 10% now. Unemployment in the U.S. has dropped down to 9% from the 9.4% previous level. The unemployment rate, when you take the time to look at how they actually compute the unemployment rate, it's actually I saw an expose on the news not too long ago how the unemployment rate is actually computed. It's actually kind of disappointing how inaccurate the unemployment level is representative of the actual unemployment rate, at least in terms of the U.S. That it's a statistical poll. They ask a certain amount of people, and they say, well, these many people are unemployed. That means that those many people should be unemployed, and it doesn't take into consideration the part-time employment, those people that have jobs but are not working as much as they'd like to, and those people that have just dropped out of the workforce. That's what the economists always say. Unemployment goes down. The economists get on the news and they say, yeah, the unemployment went down. That's because less people are looking for work. So they say in the U.S., unemployment's at 9%. The real unemployment is near 15%. Spain has historically, as far back as I can remember, even back to the 90s, has had higher unemployment than most countries in Europe. 20% is huge. I remember even seeing levels of 25% at one point. I think Germany has slightly better unemployment than Spain. Spain and Portugal are typically on the lower end of the spectrum, just the way the economies are put together. Unemployment is a big problem. Now, the other numbers, a few weeks ago we had the IFO number and the ZU number. Those both, if I remember correctly, both showed improvements. In fact, let me show you something while we have just about another minute or so. I know this is about technical analysis, but then again, everything kind of fits together. I'll show you a little experiment that I've been sort of tracking. I think I've spoken about this before, but I think it's kind of interesting. Upon the release of every significant piece of news, only the really significant pieces of news, I ask myself the question, is the news better than expected? Does the news show an improvement to the overall market? If so, I give a score of 1. This is the euro, by the way. The currency's at the top. If the news was below forecast, if it showed a decline in the economy, I'll give it a score of -1. Yesterday we had retail sales in Australia that were a disappointment and also showed a general trend to the downside, meaning worse than the previous month. Yesterday we had some good numbers in the U.S., and prior to that we had some good numbers in the Eurozone. That was the end of last week. Now, put all these numbers together, and you add up all the ones and negative ones, and you end up with the currency line. Now, the color code key is at the bottom. The light blue line is the euro. The white line is the U.S. dollar. The green line is the CAD. The violet line is the Swiss franc. The orange line is the British pound. That's actually the red line. That's the Kiwi. There's a color code key at the bottom. The blue line is the Aussie. I started this little experiment at the beginning of the year. And so far, since January 3rd of 2011, the news that's been released, and I don't have all the news, just the big news. I try to track. I don't, follow the individual French news or German news when we're looking at Europe, but rather the European news, like Eurozone unemployment rate, or the ZOO, or the IFO. Are those statistic figures we're hearing very accurate? Again, I just simply look at the big news, such as Aussie retail sales yesterday, and I just, according to the economic calendar, I just very simply take a look and say, was it better or worse than expectation? Was it better or worse than the previous month? If it's better than expectation, better than the previous month, I give it a score of +1. It's an unscientific poll. Just my own little way of trying to keep track of where the news seems to be better or worse. It's been very, very clear, though. If you take a look at the news going back to the beginning of the year, the news out of Australia has been worse more than has been better. The news in the Eurozone has been better more than it's been worse. Now, the white line, the U.S. dollar, is actually the strongest line. That's the U.S. dollar again. But take that with a grain of salt, because there has been a far greater frequency of news released in the U.S. than in any other economy, probably because I follow U.S. economic calendars. If I would take the average, the white line would probably be a little bit lower. Disregard the white line for a moment. The strongest currency other than the white line is the euro, because we've seen the best news. After that is the CAD. I'm willing to bet, my unscientific poll, that one of these central banks is the next central bank to raise interest rates, because the news has generally improved since the beginning of the year, more so than it has in Australia. And by the way, in terms of Australia, I did not take into consideration the flood damage. I did not take into consideration there was a cyclone, I believe, a hurricane or cyclone in Australia. I did not take those into consideration as well. I'm just looking at the pure economic data. So that's my own unscientific poll, but I think the benefit of this is you put this together with technical analysis, and it gives us a much better chance of making an educated decision. Okay, I want to go along the euro because I think the European Central Bank is more likely to raise interest rates sooner than, let's say, the Reserve Bank of Australia. And if we were to take a look at the euro-CAD currency pair since the beginning of the year, let's take a look at the euro-CAD. I know I'm just about out of time here. Take a look. I do have the euro-CAD. I just forgot where I hit it. Pound Aussie, euro-pound, euro-Kiwi. I know I'm getting close here. Here's the pound CAD. There's the euro CAD. Okay. So it's the euro Aussie is what I'm looking for, right? Because the euro has gotten significantly stronger than the Aussie has fundamentally. Here, I'll put it in a new chart. Euro Aussie. And I'll turn my charts back on. Okay. And since the beginning of the year, here's a daily chart. Yeah. The euro has appreciated to a very, very large degree versus the Aussie. Now, if you take a look at this news, on my little news tracking chart here, since the beginning of the year, which is when I started this experiment, the news has, every day we get a little piece of news. It has been good news in Europe and, generally speaking, bad news in Australia. Any reason why the Euro Aussie since the beginning of the year? Let's draw a line at the beginning of the year. Any reason why the Euro Aussie has gone up since the beginning of the year? I would say so. Here's a vertical line starting at the beginning of the year. Reading an article that energy, if I understand correctly, energy in the Eurozone mainly caused, or the inflation in the Eurozone mainly caused by energy. Great question. When we talk about inflation, I know we have to go, but when we talk about inflation, we talk about CPI, Consumer Price Index, and core CPI. Core CPI is the Consumer Price Index minus food and energy. Food prices have been very, very high. Energy prices, fuel prices have been very, very high. So yes, energy prices and food prices have been very, very high. Those have been inflationary pressures. If you want to get a more accurate view of the economy, though, compare CPI to core CPI. And again, this little news calculator is very, very easy to track. Every day, just take a snapshot of the economic calendar. FX3 calendar is very, very good. Make a note. Is the news better or worse than expectation? Is it better or worse than the previous month? Over time, these lines will develop. I'm out of time. However, if you want to contact me directly, please feel free to do so at www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. By the way, please see the calendar because we have a very big schedule coming back up. I want to thank you all very much for joining us. Wish you a great day. All profitable trades. And we look forward to seeing you back soon. Back inside.